Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Shannon Robnett. He is has 30 years of experience in real estate investing. Shannon's been involved in start to finish in over $350 million in construction projects such as multifamily, professional office buildings, to city halls, fire, police stations, schools, industrial projects, and mini storage. Along with his knowledge, his team at Shannon Robnett Industries, Shannon is dedicated to sharing his expertise and delivering top-notch projects that bring numerous passive income streams to his syndication partners. So, Shannon, welcome to The Wealth Flow.
Hey, thanks, Keith. I'm glad to be here.
I always like to start really with your background, before you got into real estate, really, where you grew up and what eventually led you to this profession.
Well, the funny thing is those are very commingled. I grew up, my father was a developer and a builder, and my mother was a third-generation real estate broker and continued in that profession. Finally closed down her brokerage firm at 73 years old. But she's still very active in selling real estate. She just didn't want to manage 65 agents anymore. So I grew up in that environment, and I always saw that going on, but I kind of thought I wanted to do something different and maybe go to college. And so I was doing my first semester in college, and my brother had graduated high school and was building houses in 1994, made about $45,000 that year building houses. And I thought, gee whiz, there's no way my career is going to get me to that point inside of, a decade of school and work. So I dropped out of college and kind of followed in the family footsteps and began building houses that eventually led me to realize I did not like homeowners. And so I transitioned my business into commercial real estate. And, like you said, I built some fire stations, police stations, medical facilities, light industrial. We did a lot of that stuff. And every time I did a really good job for my customers, I got fired. I completed the job and it was done and there was no residual. And I kept seeing all of these people that I had worked for and built these buildings for, they were getting rent checks every month and they were making money every month and I wasn't. And so in 2001, I built my first industrial building for myself. It was also coincidentally the same year that I finished the last project for my parents, and they officially retired at 50 years old with cash flow from all the commercial projects that they had done over the years and that they were living on. And so I saw where that was really kind of where my future was headed. And I began to work with a doctor here, a lawyer there, a high net worth individual there, and we'd do a small project. They'd provide the cash, I'd do all the work. And that was kind of my course over the next decade, 15 years. And in 2017, I started a 180-unit apartment complex with a family office that provided about $19 million in capital. And when we finished the project and exited in 22, the family office kind of dissolved and they just kind of all went their own separate ways. And so my capital source was gone. And so in 2019, I actually started raising capital on my own and not having been in the advertising world or social media or anywhere like that. I was trying to raise about $1.5 million. I think it was 1.8 million for this 36 unit apartment complex. And it took me almost 5 months to raise the money. And, through that, I learned how to put together a better PPM and everything like that, because my background came from the construction and development side. I didn't come from capital raising or being involved in Wall Street or big real estate firms or anything like that. And so I really learned how to syndicate from a guy who had been involved with Hollywood and syndicating capital for movies. And, there's just like your capital stack that you have in commercial real estate. You've got those that get in when it's just a script. You've got those that get in once you've got a couple of the actors, and then you got those that get in once you get, Tom Cruise lined up to be in the movie or whatever.
Yeah.
And I really learned how that worked and kind of put that together. And since then, we've raised about $75 million over the last 4.5 years for different projects we've done. We've got projects from Washington to Florida, into Texas as well. And so we've done a lot, and we've had quite a few of our deals go full cycle. I've had some great returns for our investors, and really help them identify the tax strategies that they want to use in how to maximize their profits and then keep most of that so that you're not just working for the IRS.
Yeah, for sure. No, it sounds like a tremendous background. Everything from your parents. What type of stuff did your dad do some developing as well?
Yeah, he did industrial development, small bay industrial.
Okay.
He did multiple subdivisions. Did a lot of buying old properties, rehabbing them, demoing them, doing all kinds of stuff. But he did quite a bit of the small bay industrial development stuff.
Okay. And on the like on the buildings, the office buildings, whether they be the city hall, the fire, police station, those you were commissioned for doing, just the construction side of it. Is that so from start to finish, it was going to be the same owner.
We did a couple of we did a couple projects for a local gym that recently got bought out by Crunch Fitness. If you think about it, a gym is a membership-based business, right? You're getting a loan because you have members. Well, if you're opening a new location, you don't have any members, right?
Yeah.
And so we would build the gym, and then lease it back to them, and then have them. They had the opportunity to buy it out in 24 to 36 months, which was fantastic for us from a tax side of things, because it allowed us to take it from regular income for building a building into long-term capital gains and the ability to 1031 out, because we had owned it and it was rental property. And it was kind of things like that along my path that really showed me that being tax efficient in how you do things is more important than anything else in the deal, because the single largest expense in any deal you do is the tax problems that deal creates and or solves when you get involved with them.
Yeah, that's a great point. And maybe for the audience, Shannon, can you maybe explain that a little bit more? When you say, so obviously on that gym example, you had an opportunity to build it. If they did have the ability to get the loan because they had the membership base and everything, then it would have been a transaction that would have just been income for you.
Right.
And because you were able to postpone that.
Exactly. So what I did, we came in, we designed it. We said, hey, this thing's going to cost you $3.7 million. They said, okay, we assigned an 8 cap to it. So, based on that, we knew what the rent was going to be, because I wanted to get an 8% return on the project. Mm-hmm. And then they were able to buy it at the cap rate, which at the time I think was like a 7, So we were able to make a little bit on the spread. So we built it for 3.8. I think we sold it for 5.2. a year and a half, 2.5 years later, but they were able to open the doors with no members and get that up to where they could get the best possible loan for themselves. And then they held that for 30 years. And if you're going to do that in the commercial space, getting a really good loan versus, no member loan, you're going to save a lot of money on your interest side of things. And especially if that's a long-term hold for you. So it really was a win-win for both sides. And we did that with them a couple of times. And it was kind of really where I saw, hey, wait a minute, we can build this. We can hold this as investors. We can exit, 3 to 5 years down the road, let somebody else maximize that. And we can move on. And it was just kind of little lessons like that throughout my career that really kind of brought me to the place where I understood that, hey, you know what? Investing it's not a solopreneur thing. This is a team sport, and involving other people in that is beneficial to everybody involved.
Yeah, for sure. No, that's great. Have you done more of those types of kind of leaseback since then, since the gym?
We haven't done as many of those because the reality is that if you have the property, you don't really have to lease it back to them, right? I mean, there's something to be said for location, right? But the other side of it is you apply the golden rule to that, and that's he who has the gold makes the rules. Well, he who has the land makes the rules. So you're able to. I realized that while that was good, because I don't know that I would have wanted to pursue and build for a gym client. That can be such a tricky game. It's not something I ever want to run or own, and so for us, it was great because these guys had 4 locations other than this and everything. But the leaseback does have some great opportunities in it. The thing that I didn't like about that we were doing is we were assigning a value based on today. And if you look back at what happened in 2020, 2019, when cap rates really came down, we would have been in a pretty bad spot if we had fixed our price based on a 7 cap. Yeah. And that product came down to a 5 cap, we would have left millions of dollars on the table. And so what I will do without hesitation at all is put in a first right of refusal. So you're my tenant, Keith. It's been great. You've been with me for 10 years. Your lease comes with a first right of refusal. If I want to sell this, I will ask you first, do you want to buy it? Right.
Yeah.
And then I'm able to negotiate based on the price, based on my desire to sell, and then being, opportunistic with having a built-in buyer should you want to have that.
Yeah, for sure. Let's maybe talk a little bit about your the capital raised piece of things. You had this family office that helped you with the giving you the opportunity to build this multifamily. And supplying the capital on it. But then all of a sudden, like you said, they sort of dissolved or went different ways. How did you go from, struggling? Maybe I wouldn't say struggling. You still were able to raise it, but
I was struggling.
Yeah.
5 months to raise $1.5 million. That's a struggle, Keith. Right, that is a struggle.
Yeah. To all of a sudden now, so what did you do to build your investor base and really get to the spot where obviously you've got the experience, you've been in the industry for quite some time, you're somebody that knows and understands the construction side of it. Now you're having to play maybe put a different hat on of raising the capital. What did you do? What were some of the things that you did to get to a spot where you didn't?
I think that's really what I did do, Keith, was I told my story. When people, I just read on Facebook this morning, there's a person lamenting how the syndicator that they're working with is not being truthful and the deal's going south. And, right there at the fever pitch of the market, everybody was a syndicator. I'm not a syndicator. I'm a contractor. I'm a developer that raises capital through syndication, and syndication is honestly just a fancy word for partnership. I mean, just like a souffle is just eggs, I mean, but what I look at is, what is the experience? How do you convey that experience? I have spent 30 years. I've done, I remember when I was building one of my first buildings, I went and got my CDL license and bought a dump truck so that I could haul the gravel to the site. I've done all the excavation. I had a septic installer's license for 25 years so that we could perform that on our projects. There's a lot more that goes into this game of real estate, and really getting the ability for people to understand my story and how 30 years of expertise is going to be way better than a 5-day workshop. It's going to be way better than somebody that's TikTok famous that's coming in and going, "Hey, I'm in real estate now." Unless they're hiring and have a team of advisors that is this kind of depth in the bench, you're going to run into a lot of things that are going to shake you to your core. Real estate is definitely a good way to get wealthy, but it's not an overnight thing, and you've got to understand the inherent problems that come with real estate. I mean, imagine being a property owner in Florida right now. You just had Helena and Milton rearrange your yard twice.
Exactly.
What are you going to do about that? How do you interact with insurance companies? At what point do you turn this into insurance versus cover it yourself? How are you compensating? How are you retaining tenants? All of those kinds of things that I've done over 30 years are very important, and they don't seem like it when it's all roses and loans are at 3%. But where's your negotiating tactics when your loan is due and the bank is in a position that they can't loan you what you need? You hear this story all the time, right? You've got a project that they bought for $18 million or $40 million, pick a number. Cap rates have come up, rates have come up, and they're now looking at a project that is 15% underwater on paper. The cash flow now does not have enough DSCR, or debt service coverage ratio, to cover the loan, and they're having to come to the table with $4 million, and that dilutes their investors because they didn't think about getting long-term debt, right?
Yeah.
And those are the kind of things that, I mean, I would hear that all the time. Why do you have short-term debt? Well, it's 3/4 of a point less. If it takes 3/4 of a point to make your deal work, you're gonna wind up throwing yourself off a 4-story building not very long from now with the problems you're gonna run into. Looking at that 3/4 of a point is the only way you're making money.
Right.
I mean, Keith, I mean, another great example is I have a property management company, right? I don't have a property management company because a property management company is profitable.
Right.
But I have a property management company because if you think about it, Keith, everybody that has a company, the goal of the company is to make money for the company. Well, if that company's job is to lease at the highest rent, manage the costs at the lowest that can possibly do that, and charge as little as possible, how good of a business plan does that sound like to you?
Right. Exactly.
As far as the property management goes? But when you take that and you go, hey, you know what? We did that $35 at a time on all 200 of these units. You're talking millions of dollars.
Yeah.
So I have a property management company because I'm in commercial real estate, not as another way to make money. And I look at all these people that are saying, oh, yeah, I'm going to take on the property management. That way I can quit my job and I can live. That's not what property management is about. It's not here to feed you, because the bigger gain is in the project itself and managing to the lowest coefficient of cost. Yeah. And a lot of people miss that. And that's just, that's, I hate to say it, but that's what experience buys you, falling it down the ladder, rung after rung, over the last 30 years. That's what's bought me this experience that then shows me these are the right things to do and these are the wrong things to do. And we still have plenty of our own challenges, right? I'd hate to be sitting here trying to manage $75 million of other people's capital and expectations with a 7-day boot.
For sure. No, but we're very well said and makes a whole lot of sense. What type of projects are you doing? Now? So one of the last ones you had mentioned with the family office was a multifamily apartment complex. What type are you and your investors getting in right now?
Yeah, so we have a couple of industrial projects right now. We're just wrapping up one in Pensacola, Florida. I love the industrial space, especially in dicey markets like this, because industrial is a triple net lease, which means that all of the property taxes, the maintenance, the management, the roof repair, parking lot, property taxes, insurance, all of that stuff is a tenant expense. So I have number one, I have long-term tenants with 5 to 10 year leases. I have people with balance sheets and personal guarantees. I have I have the ability that when the situations beyond my control change, like my insurance rates in Florida, they're going to go
Right.
through the roof. That's a tenant expense. The tenant knows that. But the flip side of that is when you look at the apartment renter, they are somewhere between 35 and 45% of their gross income for rent. When you look at a business owner, they're somewhere between 8 and 12% on their balance sheet of their gross receipts is their rent. So they are in a completely different boat when you raise their rent $300 a month. So we love those industrial projects. They typically come with the longer horizons on them. They're great for cash flow. And then we have several multifamily projects that we're involved with right now. One we're just wrapping up. I think we just got to 90% stabilization on the project in about 4 months. So we've made a good pace of that. And then we're starting phase 2 of a 200 unit apartment complex with 191 apartments and then 9 single family homes. So we're starting the second and final phase of that this year. And then we're just looking for what else is next and what's on the horizon.
Okay. So primarily the light industrial and multifamily.
Yeah. And I like the new stuff, when you look at demographically and you look at nationwide, in the C and D class apartments, those people are paying the highest percentage of the rent to rent, which means in an inflationary environment like this, they're the ones that are getting clobbered the hardest, and it's the hardest for the landlord to raise the rent, right? If you're raising rent on somebody in a C class apartment, and by C class, I'm talking a 1980, mostly original, probably under $1,200, $1,400 for a 2-bedroom apartment. When you're raising rents $50 and they're already paying 42% of their income to rent versus a Class A apartment dweller who is somewhere in the 30 and under percent, I've seen it as low as 23%, between 23 and 30% of their income, which is reasonable. They're living in your place by choice. And those are the best ones to have because they treat things better, they stay longer. And we also kind of have the philosophy that we want to be $35 a door more than the guy than anybody in our 5-mile radius. And the reason that we want that is we want to be able to be comparable, but I want you to stay with me for the price of a couple of pizzas because I know that that's your choice. And Keith, when you make the choice to pick us over anybody else, there's a reason for that. And I don't care what the reason is, but it also means when I raise your rent, that $35 isn't what's going to affect you to call your buddies up, buy those 2 pizzas, load all your crap in their truck, and move down the street, right? You're going to stay put longer.
Yeah, makes sense. What where are you building the multifamilies, or where is it pretty well geographically? Where
We've
all
got
are
a
you
lot of it
focused?
going in Boise, Idaho right now.
Okay.
We are blessed to be in one of the hottest markets in the nation that's held strong. I was just talking to a realtor this morning on comps. Our housing prices are up 7% year over year. We're still seeing strong demand. And when you're talking about median priced houses at 4.25, that's a $3,800 payment. If I've got a 3-bed, 2-bath for $2,300, it tells me I got a lot of room to raise rents.
Yeah, for sure. And are these all from the ground up construction?
Mm-hmm. Yeah.
Okay.
We do have a couple of projects in our portfolio that we bought. We just don't like them as much. the value add, the lipstick on a pig. Things are changing. The way that COVID changed how people work from home. We were just starting to draw a project when COVID started, and we wound up drawing our 1-bedroom. We did a 1 and a 2-bedroom with a very small desk built in that had doors that closed. It kind of created an office of about a 6x8 office that was kind of open to another part of the apartment. But those were our number one renters. We rented out of those like the first month. We were all out of those because people see the value of work from home now that wasn't even in the thought process in 2018 for building into product, let alone 1985.
For sure.
So, and we've just stayed in, we've stayed in hotter, I would say more resilient markets. We've got some in Washington. We're looking at some stuff right now in Denver, also in the Phoenix area.
Okay. Well, are there some things that are part of these multifamily projects that beyond the desk that you mentioned, from a technology standpoint, ways to be able to be efficient with utility? What are some of the features that it seems like tenants are really after right now?
One of the things that we look at is how do we involve technology, right? So in our clubhouses, we're designing in phone booths, literally for you to be able to work from the clubhouse and go take your phone call. Well, we call them Zoom rooms, but it's a modern day phone call, right? We've got high-speed wireless that we provide with T1 lines into the project because we can get a bulk price and get better internet service for our users. The technology packages that are the wireless doorbells, or the Ring style doorbells, the temperature control, all of that kind of stuff, as well as Amazon lockers that are being built into our facilities. So they're not the afterthought. You're not sticking an Amazon box out in the middle of your playground on a concrete pad because you don't have room in a ridiculously small clubhouse. Last clubhouse we built was almost 5,000 feet for 200 units.
Really? Wow.
Yeah.
Wow. And is that some of the things that are drawing people? Is you got the clubhouse, you've got the pools, you've got the various, just the amenities that are really allowing you to charge that little extra for yours?
Well, because Keith, think about it. 5 years ago, people thought about their apartment, but they just lived there, right?
Mm-hmm.
Well, we go through COVID. Now everybody's realizing these may be the only amenities I have access to.
Yeah.
Having this gym facility now really matters. Yeah. Having this internet really matters. Having these kind of amenities around in the complex really matter. 10 years ago, there's no such thing as a dog park.
Right.
Now we do a dog park in every single one of ours where Fido can go run and play because everybody's got a dog.
Yeah. Yeah, makes sense. What and as from an investor standpoint, right? These are projects that give us some timelines. When you're going and you're purchasing a property, you're finding a property, you're getting it where you're able to build the apartment complex. Are you doing all that before you actually purchase? Give us kind of a timeline on what from a development standpoint, what does it take to break ground? And then from there, is that the same investor that was in there from the beginning that's in there now? Or is it a new, different, do you have different phases?
Well, first of all, there's two things that I do that are very different than what you just described. First of all, I don't get my investors involved in the project until they are ready to go vertical.
Okay.
The investors should not be taking that risk. I have a project that I told you about, the 200 unit apartment complex. It legally, according to the ordinance of the city, I could have put 470 units on there. If I would have built my pro forma out based on those 470 units, it would have been a very different project than what I went to deliver, with very different return matrix than what was actually there. But by the time we got done, compromised with the city, the neighbors, got everything designed in there, built the amenity package, all of that kind of stuff is all done on my dime. So
Okay.
I bring to the table a complete package. I don't mark up the value of the land now that it's entitled versus what it was worth before. I bring that in as part of my sweat that makes me worth working with. The other reason I don't mark that up, Keith, is if things go south, paper equity is the easiest thing to eat because it didn't cost you anything.
Yeah.
Now, we do get reimbursed for our work, but we'll bring together the completed project. It's all approved. Plans are done. We're ready to begin construction. Lending is we're finalizing. We bring our investors in. They are the ones that go in and purchase the ground because a lot of that entitlement work is all part of the negotiation with the land purchase. So, there's the saying price or terms, right? Keith, you want $10 million for your property. I can see that it'd be worth $10 million if I can get these things to happen on it. So
Right.
if I can get 500 units on there and I can do these kind of things, so I go to city council, we work out a deal. I go to city council, I get all that approved. I paid the money for the engineers, the studies, the building permit set of plans on a 200-unit apartment complex, about $500,000. All of those costs are out of pocket. But as we come to the syndication part, as the general partner, I invest 5% of the total amount raised of my own personal capital. So I'm doing that from the very beginning, and I'm bringing the project to you. I'm really coming to my investors going, hey, we're equals. I can't do this
Yeah.
without you, and you can't do this without me, which is not an attitude that a lot of syndicators have. They look at it and go, I'm going to allow you to partner with me. Well, that's not really how this works. We need each other to do this and to do this well. And so from that time point that my people get involved, if you think about it, there's been a lot of syndications that have happened where you buy a 1965 apartment complex, you go in, you do the value add. All we're doing is the original value add. We're taking it from bare ground, sticks and stones, to the first stabilized number that says, hey, you spent 10 million on it, but based on your rents and the cap rate, it's now worth 15, right?
Yeah.
And so we're not buying somebody else's blue sky. We're in there, we're putting together things right. The nice thing about doing it this way, Keith, is if you wind up in the situation where you've got to hold it a couple, 3 years longer, you're holding brand new product. You're holding the top of the market. You are the premier pricing, and you're going to wind up with the best returns versus somebody down the line in a B or a C class product. And
Yeah.
so we've got the best available in the market. It's the brand new stuff. And then what we look at is getting that from construction to stabilization. And at the stabilized price, we've now come to somebody and said, hey, we can sell you a cash flowing asset. We've built this thing out to where it's at. It's a cash flowing asset. It's reached its highest peak value. You're going to ride it up from there at 3, 4, 5% a year based on what rents do, which the last couple of years, they're now going back to historical norms, and so we've created that original value add, which what most investors don't realize is they come to us syndicators asking for cash flow, but if they really understood what they really needed out of their portfolio, they need wealth accumulation.
Yeah.
And I always ask this question to people. I say, if you take your amount of money, you know how much you have, all your equity, can you live on a 6% return on that? And most people will say, no, I can't. There's no way. Then what you need to do is the fastest way to grow that wealth to now you have a number that you can live on, right? And that's really what we look to do with a lot of these development projects is it's a 24 to 42 month cycle that gets the product built with the most assurance that you're going to be at the top of the market when you're selling, and then you're exiting at that point. And then, you've achieved a really great return that you're now able to do a 1031, a tenants in common, many different things on how you take that back into your portfolio and then reallocate that.
Okay. And do you work with a lot of the same people that end up purchasing it at the end? Like, that they're looking for an A-class apartment complex, or is it usually it's different people each time, depending on the market?
Well, it's kind of like pretty girls at the beach, Keith.
They're
If you're with one, everybody wants to talk to her, right?
right.
And so we have no shortage of people approaching us about our new product because there really are. There's quite a few people that are what I would call merchant builders that build apartments and sell apartments when they're finished. And so we get approached quite a bit. We've never actually gone to market with one of our finished products. We're always approached before that because maybe I'm known for always selling something. But the other side of that is, we the last apartment complex we sold for $64 million. We had one group approach us about 6 months prior to when we were ready to sell, and another group approach us 2 weeks before we were really thinking about doing something with it. And so we just contacted both groups, gave them the package, and said, "Let us know," and picked our winner. But again, it's very easy to sell product that's brand new and doesn't need anything.
Yeah.
I think there was a lot of people got into the value add, and I even heard the term heavy value add, which that to me means you need to bring 5 gallons of gas and a match. But, you've got the heavy value add where that was all that was available to syndicators, and they
Right.
were way overpaying for that. Where, I was looking at some of the pricing in early 2022 where people were only about 25% difference between what they were paying for a 1980s version versus what brand new would cost, and not seeing that their metrics were really the same, and they were 25% cheaper, but they were always going to be worth 25% less. Why would you
Yeah.
do that? Why wouldn't you position yourself into the top of the market, right?
Yeah, I think that experience that you're talking about comes into play there. I mean, just not knowing, a lot of people know the, value add game, and they can see, okay, if I do this, this, and this, but your picture's taking a clean slate and going all the way up with it. And if you haven't done that before, it's sometimes hard to see it. So
Yeah. Yeah, I mean, there's definitely a special resume that a lender wants to see, when they're loaning you, $52 million before you get to finished product.
right.
I mean, if you're buying a value add and you're asking them for $52 million, they're going to look at it and go, well, they've got enough cash flow, and their pro forma only shows them taking 10 units offline a month. Worst case scenario, they get 20 units or 30 units offline. That's, 20% of their product. I guess this won't be too bad. Where when you're spending a lot of money before you have the opportunity to get a door open. There's some real challenges with that, fortunately my resume does speak bank, and they like that part. And so we've been able to do that. And, the value add, it's just interesting because things become outdated,
Yeah.
I mean, there are floor plans out there that don't work very well, that aren't conducive to modern lifestyle. They're not really a lock and leave type of a product. They don't have the ability for you to get, internet in the building because it was built out of cinder block and steel in the 60s. There's just different things like that we just don't seem to have those issues.
Yeah, for sure. No, that's great. And as far as say the light industrial, and I guess with the apartments as well, you mentioned having property management. So that's even on-site leasing. All that is done through your company.
Yeah.
And,
We will hire leasing agents in the market, but
Okay.
as far as the lease negotiation and all that, price, terms, everything else, and see, think about this, Keith. If my property management is looking at it and knows what our strike price is, knows what our exit value is, they're constantly playing Monopoly, right?
Yeah.
They're constantly looking at it going, hey, you know what? I got 4 leases already this month. I need 6 for the month. I'm going to raise rents. I got to slow this down. I got to make more money, right? And they're constantly playing that game that I don't have to. right? Because they understand what our end game is. They're constantly controlling costs. With the industrial, we just did a deal with a tenant where they needed a $500,000 tenant improvement. Well, what a fantastic thing for us as investors, because we could take that as QIP, which is qualified improvements, and take that out over the lease. So there's some more bonus depreciation for us. We put it on the tenant and a 5-year loan at 8%. So they were paying a higher rent, which raised our sales price, right? And they were able to see that game instead of having a negotiation where those points were disconnected and then property management sitting there going, well, now what am I supposed to do, right?
Yeah.
And how all that fits together, right?
Yeah, that's interesting. And I guess obviously you got the construction side of it as well. You've got the vendors, you've got everything on the back end that you've really put together over the years to be able to deliver this product at the best possible price and most economically.
Yeah. I mean, even in industrial, the architect wants to design the Taj Mahal, right? Where we have the design build philosophy that, look, we've got to be in and out of this product at $140 a foot, because our pro forma is showing $1.30 for rent. These numbers have to be there. So we're keeping that in line from the very beginning, and the property management's already done the pro forma of the area. They know where we need to be. We just finished a 6-unit small bay industrial project. We had it tenantized before completion, and we were at top of market because of what we were able to put together that way.
Okay. Yeah, no, that's incredible. What on apartments? Going back to that, you're obviously pre-leasing a lot of this stuff. So are you building? Tell me a little bit about. Are you building some of like the clubhouse and that stuff initially ahead of units? Or are you building a unit, one phase of units, and then saying, "Hey, here's this," or how do you roll that out so that you can still attract? I'm just thinking from a leasing standpoint, being able to attract the tenants, knowing that it's not just, this picture on the wall of what's going to come. They're starting to see something there.
Yeah. Well, Keith, I think people are getting cynical in life, and the promise of a clubhouse never has worked well.
Yeah.
And so one of the things that we do is, even though it front loads the costs in our pro forma, it allows us to have better rents. And so from the very beginning, we're getting top of market rents because in our project that we've been talking about, that's a 2-phase project, all 95% of the amenities are already done. They're done in phase 1 because that's what I don't have to convince you that I'm putting in a pool. It's right there. Volleyball court, right there. Shuffleboards inside, pool table, all that stuff is already there for you to come and enjoy. In fact, you get a benefit by leasing early because now there's only 30 of you in the complex. There's not the full 200. Now there's 50. Now there's, what I mean? So we do that kind of stuff because the promise of what's going to be tomorrow, I think America's a little too jaded for that line anymore.
Yeah, makes sense. And as far as like the various phases of like on the apartments, just curious more than anything else, kind of how this lays out since you've got the development experience. So you've got, as you mentioned, you're building out 95% of the clubhouse and the amenities, and then you're starting phase 1. At what point are you starting phase 2 right as soon as you can, or do you get what amount of lease up do you want in phase 1 before you start phase 2?
So this particular project, we started it right as COVID was beginning. We dialed it back because we didn't know where the economy was going. We did all of the infrastructure. So all the parking lots are in, all the curb gutter and sidewalks in, sewer and water. So minimal disturbance of the site, other than, nail guns banging and things like that. But for this, we had to go through a subdivision process because we had a public road that needed to bifurcate the project. And so in doing that public road, we had to go through this process, which was going to cause more delay than the actual time it would take to build. So we brought on phase 1. We recorded the plat in June. We're now breaking ground on the second phase. So it was just a matter of getting everything done, getting the units filled. We're at about 80% occupancy on that project in 4 months on the 66 units that are in phase one, and we're pushing hard to get phase two in the ground. We've got one foundation in, and we're going vertical on those just as fast as we can. So this one was a kind of an interesting one, but the other thing that you look at too, when you want to look at, I just finished another project where there was 3 buildings, and just the logistics spacing between the buildings worked out really well for leasing. We had, the framers were about 6 to 8 weeks to frame one of the buildings, which put the first building 8 weeks ahead of the second building, 8 weeks ahead of the third building. And so by the time we got all done, we were about 70% occupied in the first building. When the second building was finished, we had some people that preferred the ground floor for whatever reason. So we had that. And then by the time we got to the third building, we were tracking at about 60% occupancy before the third building even got online. Huh. And so when you look at that, everybody goes, well, what do you do in an initial lease up? The other thing that we do is we offer 6 and 9 month leases as in addition to our 12-month. So, if we finish a building in March, the last thing you want is 24 tenants trying to renew in March, right?
Yeah,
you want to stagger those out a little bit. You're going to get some that are going to drop out due to delinquency or just life changes. But if you can incentivize people, we were doing very well because we could get a $200 premium for a 6-month lease, right?
Okay.
And so now I turn it into a benefit to you because you've got a job here in town for the next 6 months. Nobody will rent you an apartment for 6 months, but I will. And so you're able to, you're willing to pay a couple $100 more a month because it's cheaper than the lease break fee. And you're able to get what you want and get what you need to move forward. And then we've been able to mix up those timelines as far as when things come to be renewed. And yet in Idaho, like a lot of the Pacific Northwest, we have a leasing season. It's May to September. And so the majority of our leases do renew during that time frame, which is fantastic. But we do have other ways to segment and offset so that we're constantly looking at renewing along the way.
Yeah, no, that's smart. I like that. That's an interesting way of doing it for sure. I've always thought anything less than 12 months, we're just trying to get that dang tenant, and it's like, then there's the turnover.
To sit there. Yeah, looking at 200 empty ones, and you've got 5 filled, but they're all sitting there waiting.
Exactly. Well, this has been great, Shannon. I'm sure there's probably something I didn't ask about you or your company that maybe I could have or should have. Is there anything else you'd like the audience to know? Obviously, I want you to get an opportunity to tell everybody where they can find out more about you, if they'd like to invest with you, if they'd like to see future projects.
I think one of the things I just want to touch back on, Keith, that we talked about for a brief minute is just the tax game. And it's fresh in a lot of entrepreneurs' minds because we just finished our tax extension, right? Those were filed a couple days ago. But, the biggest thing that people can do for their portfolio, for their future, is minimize their taxes and look at how you're really needing to pay versus paying. Because, I had a pretty good year. I sold one of my apartment complexes this year and I still had a 0 tax, right? Because we strategize, because we put things together. That puts me in a place where I have more funds to invest to get a return for myself because while I know that Uncle Sam does a fine job of managing our money, I don't, I'm just kind of, I guess, call me a control freak, right, Keith? But if people can pay attention to that, and if you want more information, we do a lot of tax planning with people, helping them figure out the best way to maximize, regardless of whether or not they invest with us. We can show them how to maximize their tax benefits in how they structure themselves. And by doing that, they give themselves more investable capital. But you can find out more information about me just at shannonrobnett.com. You can get to all my social media channels there. You can even book a call with me and we can talk about your current situation and see what the future holds for you and what you're wanting to do with your investing.
Fantastic. Well, this has been awesome, man. I appreciate you being on the Wealth Flow. I do have a couple other questions for you that I ask every guest. One would just be any advice you might give somebody who's maybe just starting out in their investment journey.
I think the thing that I really see is look for longevity, look for track record, look for I had an investor, sadly, a year and a half ago, we kept talking about stuff, and he kept finding guys that were offering a better deal. They were offering a better return. What's posted is our best guess. We're talking about 3 to 5 years down the road. But what information is going into that spreadsheet to come up with that number? And sadly, this gentleman lost several $100,000 because of some of the investments that he made because he wasn't looking at who was doing it. What's the track record of the people involved? How many years of experience do they have in this field? Any more than you would look at going to a surgeon that just got out of surgical school last year for open heart surgery, right? You want to see that track record. You really want to verify that who they are is who they are, and they have the results. They got the trophies on the wall. They've got the happy investors that you could talk to figure that out and really vet, not so much the project, but vet the sponsors, vet the people that are in control of this, because they're ultimately in control of your future.
Yeah, I think that's great advice. How about a book recommendation? It doesn't have to be real estate related, but it certainly can be. Just something you've read that's been impactful.
I was just getting ready to finish one that I really enjoyed, and I just blanked on it. But 10X is easier than 2X.
Yeah.
Great book. What it's helped me to understand is I'm a pretty good Swiss Army knife, right? But I now have surgical steel in my office that is way better at certain tasks than I am. And I've really felt the energy in our offices shift because people are doing what they specialize in. And it's really shown me that I can do more, giving up less of my time if I'm using the right people rather than trying to use a Swiss Army knife to do everything.
Yeah, makes sense. No, it's a fantastic book. I love that one too. All right, Shannon. Well, this has been great. I really appreciate it. And thank you so much for being on the Wealth Flow. I think we'll call it a show.
Hey, thanks, Keith. It's been a pleasure to be here.
Thank you.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.